Lesson number 7, debt funding, Indian fund-based government debt and banking finance. One should key concepts one should know: hypothecation, project company, working capital, CIBIL, return on the investments. Learning objectives: business is an economic activity performed for acquiring the wealth through buying, producing, selling of the goods. Finance is the lifeblood for any business. A business requires funds for the commencement of its operations, hiring of human capital, carry of its day-to-day activity smoothly. The corporate today have multiple funding options as discussed. The commercial banks play an important role in financing the requirements of the business by providing the various credit facilities. Bank loan against the security of the properties and assets is the most common way of the funding. Alternatively, banks provide the different types of the facilities to the borrower depending on the requirement. This section will enable the students to understand the various types of the credit facilities granted by the banks, legal framework, regulatory applications, and learning the bank's conceptual understanding of the important terminologies, operating cycle of the working capital management. Now, I also named bonds and introduction: masala bonds, bank finance, overdrafts, cash credits, bill finance, leasing finance, hire purchase, import finance, project finance, loans against shares, loans against properties, bill discounting, factoring, Islamic banking. How to prepare CMA data for different types of the loans and credit facilities, appraisal methodology for different types of the loans and credit products, lesson note of glossary textiles, list of other things. Okay, now bonds and introduction. A bond is a debt instrument in which an investor loans money to an entity, typically corporate or the government, which borrows the funds for a definite period of the time at a variable or a fixed interest rate. Now, bonds are used by the companies, municipalities, states, and government, sovereign governments to raise the money to finance a variety of the projects and activities. Owners of the bonds are debt holders or creditors of the issuer. Now, over here, the bondholders is generally like a creditor, where a company is obliged to pay the amount. The amount is paid on the maturity of the bond period. Generally, these bonds durations would be from 5 to 10 years. All right. Now, based on the maturity period, the bonds are referred to as bills or short-term bonds or long-term bonds. The bonds have a fixed base value, which is the amount to be returned to the investors upon the maturity of the bond. During this period, the investors receive a regular payment of the interest, semi-annually or the annually, which is calculated as a certain percent of the face value and known as a coupon payment. These are the various types of bonds issued in India, like government bonds, corporate bonds, banks and other financial institutions bonds, tax savings bonds. Now, government bonds. These are the bonds issued directly by the government of India or by the public sector PSUs in India. These bonds are secured as they are backed up with the security from the government. These are generally offered with a low rate of interest compared to the other types of bonds. Corporate bonds. These are the bonds issued by the private sector corporates. The Indian corporates have issued secured as well as non-secured bonds. IIFL bonds issued on September 2012 were unsecured bonds, whereas the Shri Ram City Union bond issue on September 2012 itself was a secured bond issue. Now, they generally offer high interest rates than the government banks. Banks and other financial institutions bonds. These bonds are usually issued by the banks and the financial institutions. The financial market is well regulated, and the majority of the bond markets are from these segments. However, the investors expect to take care and to consider the credit rating given by the credit rating agencies before investing in these bonds. In case of the poor rating, better to stay away from such a bonds. Tax savings bonds in India. The tax savings bonds issued by the government of India for providing the benefit to the investors in the form of tax savings, along with the getting normal interest. The bond holder would also get a tax benefit. All these bonds are listed on the National Stock Exchange and the Bombay Stock Exchange of India, hence can be easily liquidated and sold in the open market. Now, masala bonds. An interesting new concept. Now, masala bonds, an interesting new concept with a unique name. Masala bonds are rupee-dominated borrowings by the Indian companies in the overseas market. This is different from form of the overseas borrowings in the sense that in the borrowings, the currency is normally dollar, euro, yen, etc. But the masala bonds are rupee-denominated. The advantage of the issuing the masala bonds is that the country does not have to worry about the depreciation in the rupee in comparison to the other bonds instruments that are denominated in foreign currencies. This is normally a big worry for the corporates with raising money in the overseas market. If the rupee weakens at the time of the redemption of the bond, the company will have to pay more rupees to repay the dollars. Many companies which had raised funds via the foreign currency convertible bonds in 2007 found themselves in a great difficulty. The rupee had depreciated very sharply during the global financial crisis. Now, in order to compensate the risk of the currency depreciation, the buyer of the masala bond will get a higher coupon rate and therefore earns a higher yield. HDFC was the first company to issue the masala bonds for the aggregate of amount of 3,000 crores and raised an aggregate of 5,000 crores to the issue of the masala bonds in 4 tranches. The first issue of the masala bond was by the HDFC Bank, a semi-fixed coupon rate of 7.875% per annum and was retained over 3 years and 1 month. The bonds have been issued at the price of 99.24% of the par value and will be redeemed at par. The all-in annualized yield to the investors is 8.33% per annum. The bonds are traded on the London Stock Exchange and not in India. Right now, many public and private companies are in the fray to issue the masala bonds as the companies have access to more funds at the marginally higher cost of the financing. The masala bonds were reduced under both the corporate debt and the external commercial borrowings for the foreign portfolio investments. The Reserve Bank of India has recently amended to the regulations, and currently it treats masala bonds under the ECB category only, where the borrower just needs to seek the RBI approval to sell those securities. The provisions in the respect of the maturity period, all in the cost ceiling, and recognize lenders, investors of the masala is under maturity period, all in cost ceiling, recognize investors. Okay, now maturity period, minimum original maturity period for the masala bonds raised up to $50 million equivalent in the INR per financial year should be 3 years, and the bonds for raised above $50 million equivalent in INR per financial year should be 5 years. Okay, all in cost ceiling. The all in cost ceiling for such a bonds will be 300 basis points over the prevailing yield of the Government of India securities of the corresponding maturity. The recognized investors, entities permitted as investors under the provision of paragraph number 333.3. Okay, the master direction dated 1st January 2016 should not be related party within the meaning of Indian IAS, that is Accounting Standards 24. Now, normal bonds versus masala bonds. Vis-a-vis masala bonds. As against normal bonds, the masala bonds are considered as a safer way of raising funds from the international investors, with the Indian corporates as well as rupee-denominated bonds, whether the investors get the benefit of a slightly higher rate of the interest as against the normal bonds. Issuer enjoys the safety in the terms of the decrement in the rupee value against the foreign currencies. All right, now bank finance, most common way of the funding for the corporates. Banking regulation to 1949 classifies the bank finance into the secured loans and unsecured loans. Secured loan means loans granted by the banks on the backing of some tangible security, while the unsecured loan is one for which the banker has to rely upon the personal security of the borrower. Now, unsecured advantages are not popular in India as they impose a very huge risk, money loss. You risk of money loss in case of the default by the borrower. Most of the bank's advances are secured ones. Only the portion of the amount of about 11% to 15% of the total bank advances is unsecured, that is usually take form of the overdrafts and the cash credit facilities. Now, banks finance their customers not only in the forms of the loans but also to the other type of credit facilities. Also, the other types of bank finance are tailor-made, suit the needs of the customers. Okay, the loans and advances wherein the immediate flow of the funds is available to the borrowers are called the funds-based facility. In the non-funds-based facilities are the issuance of the letter of the guarantee and the letter of the credit. Banks get income in the form of the fee for making the availability facility. There is no immediate outflow of the funds from the bank. Some of the credit facility which is different from the loan are described as under. Now, credit facilities provided by the bank. Facilities provided by the banks: fund-based facilities, overdraft, cash credit, bill finance, hire purchase. Non-fund-based, letter of credit, stand by letter of credit, and bank guarantee. Now, overdrafts. After bank loans, overdrafts is the most common way of availing credit facilities from the bank. Overdraft means allowing the customer to draw the checks over and above the credit balance in the account. Bank overdraft is a line of the credit that overs the transaction of the bank account balance drops below zero. Overdraft is normally allowed to the current account customers. In exceptional cases, savings banks holders are also allowed to overdraw their account. High rate of the interest is charged on a daily debit balance of the overdraft account, as these are clean advances. That is, banks do not have any securities to sell back if these facilities are not repaid. There are two types of overdraft accounts as prevalent in the banks, that is temporary overdraft or clean overdraft, and second is secured overdraft. Temporary overdrafts allowed to purely on the personal credit worthiness of the customer concerned, and it is availed by the customer to meet some urgent commitments on the rare occasions. Allowing a customer to draw against his checks sent in clearing, known as against clearing, also falls under this category. Secured overdraft is allowed up to a certain limit against some tangible security like bank deposits, LIC policies, national savings certificates, shares, etc., and some other similar. Secured overdraft is most popular with the trades as lesser operating cost. Simple application and the document formalities are involved in these facilities. Okay, now what is this? As per RBI Directive Circular, okay, December 5, 2018 has specified for the large borrowers the following. In respect to the borrowers having the aggregate fund-based working capital of rupees 1500 million and above from the banking system, a minimum level of the loan component of 40% shall be effective from 1st April 2019. Accordingly, for such a borrowers, the loan component outstanding working capital loan must be equal to at least 40% of the sanctioned fund-based working capital, including the ad hoc limits and TODs. Okay, hence for such borrowers, drawings up to 40% of the total fund-based working capital limits shall only be allowed from the loan components. Drawings in excess of the minimum loan component shall be allowed in the form of the cash credit facility. Examples for bifurcation of the capital limit, working capital limit are provided in the appendix. The bifurcation of the working capital limits into the loan and the cash credit component shall be effected after excluding the export credit limits, pre-shipment and the post-shipment and bills limit for the inline sales from the working capital limit. The investment with the bank in the commercial papers issued by the borrower shall form part of the loan component, provided the investment is sanctioned as part of the working capital limit. All right, now we are coming here. Cash credit account, CC account. Okay, a credit facility is a short-term finance to a borrower company having a tenure up to 1 year, which can be renewed for the further period by the bank on the basis of the projected sales and satisfactory operations in the account during the period of the finance. Fresh credit facility is extended into two forms: open cash credit and key cash credit. Open cash credit is a running account just like a current account where the borrower is allowed to maintain a debit balance in the account up to the sanctioned limit of the drawing power, whichever is lower. Cash credit facility is offered to the borrowers normally either against the pledge, key cash credit, or hypothecation of the stocks of the raw materials, semi-finished goods, or the finished goods, or the book debts receivables. In the case of the key cash credit, the borrower lodges the stocks in his godowns and the key of the godown will be handed over to the bank. By this process, the goods lodged in the godown are pledged to the bank. Okay, and the bank will allow the customer to draw the funds against the value of the goods less its safety margin. This is known as drawing power. Wow. The pledged goods are allowed to be removed by the borrower on remitting into the CC account the amount equivalent to the value of the goods. The bank would release further funds to the borrowers within his drawing power DP sanctioned limit on the borrowing, depositing, pledging more stocks in the godown. Now, therefore, this is facilities called the key cash credit. Cash credit limits are also sanctioned to the borrower against the security of the term deposits, LIC policies, NSCs, or the gold jewels. This type of the limit is offered mainly to the traders who find it difficult to maintain stock register and submitting periodic stock statements. Where the security of the CC facilities, jewels, and the life policies see now devices, there is no need to submit a periodic stock statement. In case of the manufacturing units, the facilities available is required for the purchase of the raw materials, processing, and converting them into the finished goods. In case of the traders, the limit is allowed for the purchase of the goods when they deal. Alright, now bills finance. Bills finance is a short-term and the self-liquidating finance in nature. The bills can be classified as demand bills and the yuan's bills. Demand bill is purchased and yuan's bill is discounted by the banks. Okay, the credits available to the seller against the bills drawn on the letter of the credit either on site draft or yuan's draft are called bills negotiated by the banks. The advantage of the bill finance is that the seller of the goods borrower gets immediate money from the bank or for the goods sold by him, irrespective of whether it is a purchase, discount, or negotiation by the bank. Now, the only demand bills can be documented or clean. Usually, the banks accept only documentary bills for the purchase. However, the clean bills from the good parties are also purchased by the banks, which have a clean repayment record. Now, loan against shares. Banks are permitted to provide loan against shares, convertible bonds, and the debentures, units of the equity-oriented mutual funds to the individuals, subject to maximum limit of 10 lakhs per individual if the securities are held in the physical form and 20 lakhs if the securities are held in the demat form. From the banking system, the banks stipulate higher margins, including the specified minimum cash margins on these loans as per the credit policy, 50 to 60% in case of the physical form and then 25 to 40% in case of the demat form. All right, we were at bills finance. Now, the documentary bills may be drawn by a seller with goods drawn on the DP delivery against payment, or the DA delivery against acceptance terms. In case of the delivery against payment terms, the documents of the title of the goods are delivered to the buyer of the goods drawing against the payment of the bill amount. In case of the delivery against acceptance, the documents of the goods are titled to be delivered to the drawing buyer against the acceptance of the bills. These are the bills called the usance bills, which means the bills are maturing on the future date and the payment will be made on the due date. Now, in the case of the usance bills, becomes clear after it is delivered to the drawing of the acceptance. Therefore, the banks take into consider the credit worthiness not only from the borrower but also from the drawee. Now, leasing finance. Okay, the lease is a contract between the owner, lessor, and the user, lessee. There are different types of the leases: operating lease, finance lease. In terms of the lease agreement, the lessor pays money to the supplier, who in turn delivers the article to the lessee. Now, the lessee hire of the article makes periodic payment to the lessor. At the end of the lease period, the assets is restored to the lessor. Commercial banks in India have been financing the activities of the leasing companies by providing the overdraft cash credit account, the demand loan against fully paid new machinery or equipment by the application of the security. The repayment should be from rentals of the machinery, equipment leased out, and similar other ways. The maximum period of the repayment is 5 years, and the economic life of the equipment, whichever is low. The bank is allowed to periodical inspection of the assets. Lease contracts are only for the productive purposes, not for the consumer durable. Okay, hire purchase finance. The hire purchase finance. The hire purchase transactions are very similar to the leasing transactions. In the hire purchase finance takes place predominantly in the automobile sector. Like leasing finance, the ownership of the vehicle continues to remain with the leasing company till the agreement period ends. However, at the end of the stipulated period, the hirer, that is the lessee, has options either to return the asset to the leasing company while terminating the agreement, to the purchase the asset upon terms set out in the hire purchase agreement. Since the hire purchase finance takes place predominantly in the automobile sector, the banks have started direct finance to transfer the operator as the nature of the advance being classified as a priority sector lending. By and large, most banks of finance vehicles are on the hypothecation agreement instead of the hire purchase. HPA is usually reserved to the NBFCs, credit societies, private financiers, unorganized sector. Difference between the hire purchase and the hypothecation. Okay, for a long time, hypothecation was not legally defined in India until it was defined with the Sarfasi Act in 2002. It is a charge on any mobile asset, property of the borrower, for which the bank has extended its finance. It is an equitable charge on the asset assets in favor of the financing bank where the asset is owned by the borrower as well as the possession that is with him on behalf of the bank. If the borrower fails to repay the finance extended for the movable asset, the bank can repossess the asset with the consent of the borrower if the borrower surrenders the asset to the bank. The bank has the legal right to sell the asset without the intervention of the court and adjust the proceeds towards the loan dues. Under the SARFAESI Act, bank also has got the right to sell the movable assets of the defaulted borrower without the intervention of the court, subject to the following rules laid down in this regard. Under the hire purchase agreement, as explained above, the ownership of the financed assets remains with the lender and until it is purchased by the borrower at the end of the hire purchase period as per the agreed terms between the financing agency and the borrower. Under the hire purchase, the financing entity may get the benefit of the depreciation as well as the ownership of the assets finance. Banks cannot take the advantage of the hire purchase arrangement as ownership aspects of the assets will result in violating permitted line of the activity under the banking license granted by the RBI. For example, if the bank finance public transport vehicle under the hire purchase, it implies that the banks are the owner of the public transport vehicle. It is involved in the business of public transportation, which is against the permitted activities under the banking license. Also, the hire purchase agreement, the accident express, the bank will party to the claims suit filed by the injured passengers, which will involve the monetary loss as well as the damage to the image at the bank. Now, credit facilities fund based granted to the exporters by bank. Next video.